Last week, I met with the owner of a private equity house that had managed over 200 million in assets under management. And we spoke as much about risk mitigation as we did about growth and opportunity and upside. And so I just wanted to share with you his takeaways on capital preservation over growth opportunities. So when he purchases a business, he talks about executing deals on risk mitigation. And there's four different ways he goes about doing that. The first is transparency of information. So, how readily can he get access to information of the business they're looking to purchase? Now, in a non competitive process, this is a lot easier because you have direct access to the information. The second is speed of liquidity. So, after we purchase the business, how easy is it that he would be able to take this business back out to market and be able to return investment to his fund? The third is character judgment. So, how well does the private equity house owner and his team know the business owner that they're purchasing or going into business with? Business owners come in very different shapes and sizes. And so, understanding the character of the individual is as important as the business they have built. And then finally, is the capital stack or the stack of capital being invested, and whether they can achieve a preferential treatment in the capital stack can massively protect their downside and risk. The other notable observation he gave me was that they do not make their money on the entry price, and they are less concerned about the price they pay for that business, more about the future opportunity and growth. And I think that is very well summarized by Warren Buffett, who talks about a very famous quote: he would rather pay a fair price for a great business than a cheap price for an average business. And I think this goes back to risk mitigation, which is, a private equity house owner, their worst nightmare is one of their assets or portfolio businesses going bust. And so entering into the right deal at the right price is very important to them. One of the best mitigations is buying great businesses and backing great talent. I think this links back to why private equity houses are incentivized in the right way to drive the right behavior. Although they get paid deal fees to execute a deal and buy a business, they make profit when they actually sell the businesses that they entered into. Although the industry is so nuanced, and you can find private equity houses out there that will do very high volume deals and can make money just simply off buying businesses. You need to sift through the weeds to find the real high performing funds that are only interested in executing great deals. And I think many of them are focused on risk mitigation. If they're executing one, two, or three deals a year, the assets they purchase have to be very, very high quality.